Good morning. One of the most important themes of this channel involves the importance attached to raw materials, the very top of the supply chains. There's a huge difference between how Chinese investors and companies see supply chains and how American and European investors and companies see supply chains. China's focus is on the top of the supply chain through to factories and outbound logistics to wholesalers. Business managers in Western and some Asian countries focus on factories through to the final customers. That's a really big difference, and it means that business managers in North America and in Europe have yielded raw materials sourcing and supply and refining to China. We build lots of factories, we build lots of manufacturing, but we still rely on China for the raw materials and the refining. We're looking today at how this plays out in foreign direct investment. This shows foreign direct investment holdings in the United States. As of January 2024, the total value of foreign investment holdings in the U.S. was $5.3 trillion. We Americans look at this chart, and there's a lot to feel comfortable about. Recessions come and go, presidents come and go, but the United States is still rising in its attractiveness to foreign investors. We can break down these numbers, and we see that just under half of the total is in manufacturing. We see gently sloping lines across manufacturing subsectors for foreigners investing in manufacturing operations in the United States. That's true generally for all these industrial categories except for one. This one is mining. The all-time high for investment in U.S. mining was in 2011. When the FDI mining complex in the U.S. was worth $147 billion. Now it's under 100, $90,249 million, and still falling. Foreign investors are pouring money into U.S. manufacturing and entertainment and banks and services, but they're pulling out of U.S. raw materials. A lot of foreign direct investment involves the conversion of trade surpluses to investment. Countries that run surpluses in their current account typically recycle those surpluses into investments into the countries where surpluses occur. So a lot of the inbound foreign direct investment into the United States is from countries that are taking their profits earned in the United States and just reinvesting them. This is an example from a UK source, which explains that if the UK imports goods and services in excess of exports, they need capital inflows to pay for them. A $52 billion deficit in the current account usually is matched by a $52 billion surplus in the financial account. If the UK imports 1 million pounds of Chinese clothing, it's matched by Chinese investment. If China does not send capital flows to the UK, it means more money going out than coming in and results in currency devaluation. China does enjoy recurring and enormous trade surpluses with the United States. The US runs recurring and enormous trade deficits with China then. But these deficits on our side are not being matched by Chinese capital inflows. In fact, it's the opposite. China is a net seller of U.S. assets. $1 billion a day coming into Chinese banks from its trade surplus with the U.S., but on net, almost none of it is being reinvested back into the United States. Their central bank is selling U.S. Treasury bonds. And here's what China's companies are doing. Only $191 million of new investments into North America. That's all of North America, not U.S. only, in the last quarter of 2024. That is down 90% from Q4 2023, and that's the lowest in at least 5 years. So what are the Chinese doing with all their investments? Obviously, they're not going to the U.S. or to U.S. manufacturing. They've got plenty of that here. This is a table of outbound Chinese investment by quarter. China's companies are investing instead in the Middle East and Africa, also to Asia. Fourth quarter 2024 was the third lowest level for Chinese investment in Europe, falling by over half since last year. That's black. The U.S. in red can hardly see it at all. And here's what Chinese companies are investing in. They're concentrating on raw materials. Half went into basic materials, metals, minerals, and mining projects. China is investing abroad to set up factories in other countries, particularly in renewable energy and power projects. China's energy investments abroad are at the highest level in 5 years. A key driver for that is Chinese firms setting up final assembly plants for solar panels and wind to get around tariffs. But most of China's greenfield investment goes to oil refineries, mines, and battery factories. China's outbound investment is growing fast. $173 billion moved last year, the most since 2016. When we talk about China's capital flight, money that Chinese want to invest abroad to get better investment returns, this is part of the story. A lot of the so-called capital flight from mainland China just goes across the river to Hong Kong, where it's capitalizing the new BRICS financial system. And a lot of it shows up here, going to Africa and the Middle East and South America and elsewhere here in Asia to get more raw materials for their factories. Their factories, not ours. This is Jade Snow Mountain near Lijiang, Yunnan. Be good.
There will your heart be also. No man can serve two masters. You cannot serve God and money. So do not be worried about your life, what you will eat, or what you'll drink, or what you'll wear. Seek first the kingdom of God and his righteousness.